Hi everyone, first they ignore you, then they laugh at you, then they fight you, then you win. And right now, US banks are fighting to try to remain relevant against the rise of cryptocurrencies and this new superior technology. So banks have recently sent an urgent letter to Congress warning of a $6.6 trillion exodus from the US banking system due to stablecoins that could cripple the US economy and hurt American families. So in this video, we'll be looking at this in a bit more detail to see if it is a real threat or just fiction to protect their profits. We'll be looking at how banks really create money and why they're so afraid of this new technology. So as always, please do like the video and subscribe to the channel so I can continue to offer more content for you in future. If you follow our social media channels on X, Facebook and Instagram, you'll receive daily crypto and financial education news update posts, which will keep you informed. Stick around to the end of this video to find out what services Coin Knowledge offers. Just a quick reminder that nothing contained here is financial advice, and let's jump straight in. The Bank Policy Institute, or BPI, who call themselves a non-partisan public policy, research and advocacy group representing the nation's leading banks, American Bankers Association, or ABA, Consumers Bankers Association, or CBA, Financial Services Forum, and ICBA, which is the Independent Community Bankers of America, wrote a joint letter to Congress on the 12th of August, asking them to close what they have identified as a loophole for stablecoins, because banks claim that stablecoin issuers and their affiliates may be able to indirectly pay interest or yields on stablecoins. The Genius Act doesn't allow stablecoin issuers from paying interest or yield to holders of the token. However, it doesn't explicitly state that this applies to crypto exchanges, possibly allowing them to offer yields through their partners instead. With the Bank Policy Institute putting out a post on X also on the 12th of August, stating that it is important that the requirements in the Genius Act prohibiting the payment of interest and yield on stablecoins are not evaded. But the question is why? Because the large concern for banks is if the bank's customers can get a better return on stablecoins using a regulated exchange and this loophole that they refer to, then that could lead to them withdrawing their funds. And the letter specifically mentions loans and banks then not having the deposits required to operate properly, leading to increasing lending costs and reducing loans to businesses and consumers, which could be a serious risk to America's credit system. Banks are extremely fearful of this and state in their letter that the outflow of deposits from banks could reach up to $6.6 trillion, citing a US Treasury report from April and calling this a significant deposit flight risk, with the Chief Policy Officer at Coinbase, who you can see here, putting out a response to this in a post on X on the 14th of August, claiming that this $6.6 trillion outflow from banks that they mention in their letter is pure fiction, mentioning 4 reasons why. Firstly, he stated that no experts are predicting a $6 trillion market for stablecoins, which I would add only have a total market cap of about $275 billion at the time of recording this video. Secondly, that apparently the $6.6 trillion figure was submitted by the Treasury Borrowing Advisory Committee, which consists of a number of banking industry players, not the US Treasury itself, and without any evidence. Thirdly, he mentions a study from the 31st of July from Charles River Associates that found no link between stablecoin growth and deposit outflows at community banks. And finally, he asks what value consumers are really getting from banks if customers are willing to move $6 trillion worth of currency away from them. And I'd like to take this one step further, because while the banking group's premise is correct, the banks would lose some of their cheap and stable source of funding in retail deposits, which would likely mean that they'd need to look for more expensive and riskier sources of funding in wholesale markets. It would therefore likely hit their profits, which in turn means they'd likely pass on this higher cost to its customers in the form of higher interest rates on new loans. Some may go out of business and they'd need to pivot quickly to adjust to this new technology and actually try to take advantage of this loophole themselves. We do need to unpick the idea that they mentioned in their letter that banks power the economy by turning deposits into loans, because this assumes that banks work in that traditional way of someone depositing fiat currency into a bank account and the bank then using this to loan to someone else, keeping some of the customer's currency as a reserve. However, nowadays it doesn't quite work like that, because the Board of the Federal Reserve completely removed reserve requirements for banks to nothing in 2020. So they're not required to keep any amount of reserves at all and can essentially create credit that they can loan out. The main constraints on a bank's ability to lend are more about the loan being profitable, holding enough capital that they will have built up to absorb any losses and ensure they comply with their capital requirements, and choosing credit-worthy borrowers to lend to. And this idea of banks being able to just create liquidity rather than need customers' deposits for this has been explored previously. For example, the Federal Reserve Bank of Philadelphia put out an article in June 2023 in which they detailed their research on how banks use loans to create liquidity. And they found that from 2001 to 2020, just 8% of deposits in banks were cash deposits by customers, that the availability of cash deposits isn't a big constraint on bank lending, and that liquidity creation by banks from 2011 to 2020 amounted to $10.7 trillion per year on average, equivalent to 57% of GDP. And going back to the banking group's letter now, they state that the reduction in credit supply that this would cause would mean higher interest rates, fewer loans, and increased costs for Main Street businesses and households, which resonates with policymakers and the public. And this is clever because it's framing the issue not as a competitive dispute over market share, but as a matter of national economic security. And it's positioning banks as essentially necessary stewards of the economy rather than an existing business protecting its franchise from a new disruptive innovator. Because what they're worried about here is essentially a run on the banks, as investors may look to move towards a more efficient technology. Because if you can send currency at any time of the day, any day of the week, month or year, it will arrive very quickly and cost very little, then why would someone use the current traditional financial system that only operates on a working business day, during operating hours, have to wait several days for the payment to go through, and the remittance costs being more than you think it should? So these old financial institutions need to adapt. And I'd have another question also. What's then happening with customers' funds if they do withdraw some of it from banks and buy stablecoins with it? Because this isn't often thought about, and in my opinion, goes against the banking group's idea of it necessarily hurting the American economy, because the Genius Act requires stablecoin issuers to back every stablecoin in circulation one-to-one with reserves for every dollar issued, and it explicitly defines what qualifies as a reserve asset, including US fiat currency and coins, deposits held at insured banks and credit unions, short-dated US Treasury bills, repos or repurchase agreements, and reverse repos backed by Treasury bills, government money market funds, central bank reserves, and any other similar government-issued asset approved by regulators, with this coming from Congress's website, by the way. And it can also be found in the fact sheet on the White House website, confirming that Trump had signed the Genius Act. So essentially, when someone purchases a stablecoin in the United States, under the recently passed regulation and law, those funds don't leave the US financial system anyway. And finally, I'd add that you can already get interest and a yield on your stablecoins, you can already get a loan, and you don't need to go through the banking system, because this is available in DeFi or decentralized finance, although this is a bit harder in the US. But the question asked if you're using this through the smart contracts isn't who are you, what's your credit rating, it's what verifiable crypto assets do you have that you'll put down. So I think banks really do need to change and innovate to keep pace with this new technology, rather than trying to fight, maintain control, and protect an old inadequate system. But that ends this video, and as always, I'd love to know what you think in the comments below. Just a reminder that if you're interested in more of a tailored approach to your crypto education, and you think you'd benefit from having someone look over your shoulder and guide you on your journey, I do offer one-to-one coaching to those who have the desire and the means to educate themselves further. And there are links in the description to this video where you can message me for booking a free video call to see if we'd be a good fit. You can sign up for a free account with Coinly using the link in the description to this video, which is one of the best automated crypto tax platforms out there. If you're looking for more specific crypto tax advice based on your personal circumstances, I have partnered with a leading UK crypto tax company in Myna, which is part of the company Nephos, that offers other services such as wealth management, restructuring, offshoring, etc. But I'll leave a link to contact them directly in the description of this video. I've also included a link to Trezor's website in the description for anyone looking for one of the best hardware wallets or cold storage out there in our opinion, with two new models in the Trezor Safe 3 and Trezor Safe 5 that I actually did a video on. You can find the link to here and in the description. Linked with that, we're pleased to have partnered with the #1 best-selling crypto seed phrase storage firm called CryptoTag. And I've included a link to their official website in the description of this video for anyone looking to protect their seed phrase, which is vital. If you're based in the US and are looking for specific crypto tax advice based on your personal circumstances, I have partnered with a leading US crypto tax company called Crypto Tax Audit, and I'll leave a link to contact them directly in the description of this video. And finally, if you're looking for a portfolio tracker for your crypto portfolio, then I've included a link to CoinStats in the description of this video, which is the leading crypto and Bitcoin tracker on the market. And if you found this content interesting, please do like the video and subscribe to the channel, as it really does help. And have a great day.